Well, we can file the following charts under "This is not bearish." If we zoom out on the charts and we look at monthly charts for equities and for other risk assets, so let me show you a couple of these, and let's understand the time frame very properly so that it's not misunderstood what I'm trying to say here. So we're going to look at here. We'll start off with chart of the S&P 500, the SPY tracker ETF monthly chart. So what that means is that each one of these bars that you're looking at here is 1 month with a price action. Of course, the month of April was quite the ride. We're obviously here in May. We saw a month that started off with the announcement of tariffs, and then of course that's slowly been walked back, if you will, or we got more clarification on them, however you want to frame that, right? The point is, from market's perspective, and that's all we're really doing here, we've had an unbelievable sort of exhaustion selling. And so if you were to look at this just on a month-over-month basis, we're basically right back to where we were circa the election of last year, the U.S. election. And so there's still a lot of overhead resistance, and I think in the near term we could find resistance here, but this is not bearish, right, through a 3-6 month lens. So we want to be very much respectful of that. Now, that's the S&P 500. Again, near term, we think there's probably got a bit too much because most of this move in April actually happened before all this really big move over the past few days. So keep in mind it was anticipated or front ran, however you want to frame it. But it's not just the SPY. You can look at industrial stocks. You look at a chart like this, and I think a lot of people would argue that this is not exactly bearish, right? Again, huge seller's exhaustion. Look at the QQQ, the NASDAQ 100. And again, we have near-term overhead resistance. Again, that's not the month multi-quarter view. That is the more sort of near multi-week view that we have overhead resistance. But again, if you look at this and even consumer discretionary stocks, this is just not a bearish setup. And it's because we've had this very wild ride in the month of April, and here we are. Now, you think this through and you look at maybe at this point, the whole sort of bigger recession fears have maybe been pushed out another 9 months or 12 months. I don't know. At some point, we are going to start to see. But you have sort of 3 time frames here. You have the very near term where, yes, I think we're getting overbought over the next number of days, number of weeks. But then you look at this through the lens of the next 3 to 6 months, which is really the time frame that this focuses on monthly charts. And it's not bearish, right? However, it may also not be very bullish, meaning we might still be in that trading range that we continue to talk about. And we look at the S&P 500 and we really look at sort of a longer trading range. We think at this point we cannot rule out the S&P makes new highs. That cannot be ruled out. However, we still think that V-shaped recovery where we just go back to all-time highs and then make new all-time highs for the next years, we still think that environment is no longer, right? So even though we had a very strong V-shaped reversal, we're probably at a point now where, yes, we could go back to all-time highs, or to the recent high, to all-time highs. We could make new all-time highs. But again, it's probably not going to be something that just continues for quarters in a linear fashion. And that really gets us back to that really big time frame of thinking that we are going to be in a 5+ year period where the U.S. equity market returns are going to be mid to low single digits. And so again, it's important to keep the time frame right here. Hope it helps. We'll see you in the next video.